Okay, welcome everybody. My name is Paul Hopkins. My background is more in construction engineering, project management, construction management, but I happened to trip into multifamily about in 2015 when somebody was looking for a project manager to take over a completely vacant building that was looking to renovate it and lease it up. So that's how I got my foot in the door, doing really heavy value add projects. And then excited to move into the financial engineering side of everything. So I'm going to show you basically a really high level of the underwriting, but by show of hands, who here has experience in underwriting? Okay, just a handful of you. All right. So I was going to show you a glimpse into our underwriting model. It's pretty extensive. I geek out on it, and it might blow the hair off other people, but if you really want a glimpse into it, come see us at our booth. We got a booth here, and I'll dive into it with you guys and geek out on it. So I'm going to walk around just because I got the energy and I don't want to be standing up on stage and having the focus of everybody. So I'm going to cover the 3 T's of underwriting. So what is underwriting? Underwriting is basically the process of making forward-looking projections to assess a property's future performance and viability. And it's also known as a pro forma. So in a nutshell, underwriting is making your best educated guess about future performance. Okay? We don't have a crystal ball. It's going to be nearly impossible for us to get it right. Things happen, but we need to make the best educated guesses. Right? So 3 T's of underwriting. That's today, tomorrow, and Terminus. Got to stay away from that speaker. Okay? We're going to cover each one of these today. So number 1 rule of underwriting, garbage in, garbage out. If you're going to fill your underwriting model with a bunch of garbage and things that don't make a lot of sense, if you haven't done your research using the right numbers, well, guess what? You're going to get garbage out. You're going to get the worst pro forma. So you got to take time to use the right numbers. So underwriting models, it can get really complicated, right? There's, even when you're dealing with large properties, and even some properties that have like mixed use retail spaces. So the larger the property get, the more complex it can get. And so there are plenty of helpful Excel models that are out there. You could buy them. You could create your own. Who's savvy with Excel? Okay. These are the people that you want to be talking to that are good with Excel, because you got to have that basic knowledge of how to use that. So all the underwriting models that are out there, they all do the job. They do it all in slightly different ways. So, but just keep in mind that underwriting is an art form, not an exact science. Okay, do you need a fancy model? No, you don't. You could do it basically with a pen and a paper and a basic calculator. So we're going to do a quick analysis here. So I want everybody to pull out their calculator, and we're going to go through this real quick. We're going to underwrite and analyze a deal in less than a minute. Okay? So we've got a 136 unit apartment building where the average rent is $1,350 a month. We got a 50% operating expense ratio and a 6 cap. Doing a quick back of the napkin, can anybody tell me what the value is? Anybody, just shout it out when you got it. 3.06? 18, probably a little bit closer to 18. That's what I meant. Yeah, excellent. So how did we get that? So quick back in the napkin, you got 136 units, multiply by 1,350 for the average unit rate, times 12 months, times a 50% expense ratio, you come out to a net operating income of 1.1 million. You take that 1.1 and you divide it by the cap rate of 6%, and you get 18 million. I'm actually using this exact example for a property that we currently have under contract. So these numbers are fresh in my mind, and we got this property under contract at 16.8. So again, show of hands. Who here is a geek in the sheets? I mean spreadsheets. That's me. I'm definitely the geek in the sheets. I do geek out on this stuff, and I get a little nerdy at it at times, which is fine because my background is an engineer. Enjoy numbers, and like Seth said, I got to make numbers exciting. That's my job. So hopefully I'm getting you guys excited about checking out the numbers today. So let's look at today. What do we need today? So in order for us to analyze a property, we need a handful of things. We need the address, of course. We need to know what we're dealing with. The trailing 12-month statements. So this is the last 12 months of performance. It's the income, the expenses, how is the property performing for the seller. We need the rent roll. The rent roll shows the unit type, the rent for each of the units, any additional charges, and the overall occupancy, which of the units are vacant. Sorry. Offering memorandum. So the offering memorandum comes from the broker. Okay, it has a lot of key information. They already laid out what the business plan is in these offering memorandums. The brokers have done a lot of work to market this property, or at least they should have, in order to earn their fee, right? So they've already laid out kind of a business plan for you, so use that information to your advantage. And then of course you want to know what the purchase price is. This is also known as a strike price or the whisper or the guidance, and the broker should be willing to provide that to you. Okay. So T12 versus the T3. Sometimes, when you're dealing with a smaller apartment or a unit mix, sometimes the financials aren't there. You're dealing with a mom and pop type of seller, and they're not going to have all that information handy. So you do need to create something, right? So sometimes if the T12 is not there, use the last 3 months of performance. But again, the 3-month performance doesn't really show you all the trends that you need, right? How's the property been performing over the last year is really what you want to know. And if none of that is available, you need to work with a broker and a property manager to make some basic assumptions on the property. Okay, so I do want to caution, the broker projections, they're making a sale. They want to make this property look like it's the best performing property out there. So you got to only use their projections for for helping with your business plan. So the additional documents that you want to get your hands on in order to really dive deep into the underwriting model is you want to look at any of the operating statements that the seller can provide you. You want to get basically a breakdown of all the fixed and variable expenses. You could also get this from the T12 and your property manager. Ask for any vendor contracts, so that's laundry or cable, doing any landscaping, repairs and maintenance breakdowns, payroll. How many people do you need to staff on this property? How many property managers? How many maintenance techs? The previous performance will kind of show you that, and then of course, if they have high vacancies, maybe they don't have enough leasing managers on site to work with all the tenants. And then of course, try to get your hands on CoStar reports or Yardi, and one of my favorite ones is citydata.com. Citydata provides a lot of information as far as, like median household income, population growth, all those things that you want to understand. What's going on in that particular property or that particular market. And of course, if you've got a relationship with a contractor, go out to the property, walk the property with the contractor and get some quotes. So let's break down the unit mix and the income. So the unit mix refers to basically the different types of units. So studios, 1 bedrooms, 2 bedrooms, so on. So what makes a good unit mix? Got the 2 different properties up here, for example. One, property A, has 100% 1-bedroom units. Property B has an even mix of 1s, 2s, and 3s. So show of hands, which property has greater stability, A or B? Exactly. Greater stability with property B because it has a healthier unit mix. That's a good point. Where is it located? Yeah. Where is it located? If you're like in a downtown core area, maybe studios are even better, right? What's affordable? That's a good point. So it's not always what I just had up there, but there are some exceptions to the rule, for sure. So market rent. What is the units or the comparables for this type of unit renting for? This is basically a market study. On the rent roll, it might actually show what the market rent is, and that market rent might be an arbitrary number that the property manager puts in there. Okay? Just keep that in mind. A market rent could be an arbitrary number that the property manager puts on the rent roll in order to determine the loss to lease. And I can get into an argument with anybody about what the loss to lease really is. I think it's voodoo witchcraft. So market rate, obviously the market rate is different from the actual rent charge. And this is normal. You'll see this on rent rolls. You'll kind of understand this from other property managers, but it's different. Sometimes you actually see the rent is greater than the market rent, which is rare, but that's something to keep in mind. So this is a screenshot. Sorry if it's a little small for you, but try to get a lot of information on there. Actually taken from my underwriting model for this property we have under contract, 136 units, where the in-place rents are at $1,376. And the market rent was determined by the current property manager, right? It's at $1,449. So the property manager believes that they should be able to achieve $1,449 average rents with this property, right? So my tip to you, when you're looking at the rent roll, try to separate out which of the units are renovated and which ones are not renovated. On my table up here, I've included a number or a letter SM, stands for Simply Modern. So they renovated it to a Simply Modern level of finish. And if you look at the in-place rents between the two, $1,227 and $1,250, there's a difference there. So they're actually achieving better rents for the renovated property or for the renovated units, right? So you want to try to separate that out, so you get a better picture, a clearer picture of what's going on. Okay, so with the other income, there are other items such as RUBS, utility reimbursement program, laundry, parking fees. You're also going to see vacancy or occupancy on these rent rolls. You're also going to see, if it is a good property manager, you're also going to see concessions, which are discounts offered to tenants. Maybe they have a promotion of, rent this property or this unit for 12 months, you get 1 month free. That's a concession. And bad debt. These are people that are not paying their rent. So what does a professional T12 look like? So again, you may or may not get this, but this is a T12 from our current property. And this shows the last 12 months of history for the gross potential rent and utility income. So you can see the gross potential rent here, total $2.08 million, sorry. And then this is the rest of the additional income items that are on that property. So it's a little overwhelming. But what you could do is you could categorize a lot of this stuff down into basically miscellaneous fees, pet rents, laundry, and that sort of thing. So it's important to separate out as much as you can. So another tip from me, when you're looking at the T12, there we go, lost my mic for a second. When you're looking at the T12, calculate what because normally they'll show you what the vacancy is, the delinquency, or the concessions that are offered. Calculate that month to month, and that's what the percentages show. So, and look for any trends. So let's look at the vacancy here, for example, and along the top line. So back in February last year, they had very low vacancy. It was occupied, doing really well. But then what happened in October and November and December? Their vacancy went from 1.5% to almost 8%. You want to find out what happened. And in this particular case, they had some turnover issues. They had some staffing issues. They couldn't lease up the units, so it went vacant. So, these are things that you need to kind of pay attention to. And the overall operating expenses, when you're looking at the T12, categorize them. It might be overwhelming looking at some of these T12s, but categorize them into these categories. Or if they don't have a T12, make up these categories. All right, so you got variable expenses, which are also known as controllable, and fixed, which is uncontrollable. So you don't have any control over what the utility cost is, or unfortunately, you don't have control over insurance, right? So put them in these categories and talk to your property manager about it, because this is what they live and breathe. So once you have all your operating income set up and your operating expenses, you'll be able to now calculate the NOI, which is the exercise that we did early on, right? Calculated what the gross potential rent was times 50% operating expenses to get our NOI. So it's just simply taking income minus expenses. Okay, when you're looking at the broker projection, sometimes they forgot to include certain items. They want to make their property look good. So this is where you got to dive into the numbers, see if the numbers make sense, look for any trends. So, and I already highlighted a couple of trends, like why did the vacancy go up? Ask those questions. You know, what's going on with these large reoccurring operating expenses? You know, is the property going through, is there a leak in the roof that they're having to, continue to bring their maintenance team out there and crews spend all this cash? This is straight from our underwriting model. And what I do is I actually separate out the T12 and the T3, and I show them side by side. I look for the trends right there in front of me. And what I also do is I break it down per unit. This comes in handy a lot. After a while, you do this a number of times, you get to identify where these costs are jumping out at you. Look at repairs and maintenance, a 401 or $572 per unit per year. On average, we should be where our property is located should be about 450, right? So you can see that, okay, they're kind of in line, right? So the more you do this, the more you kind of see like these typical numbers starting to jump out at you. Real estate tax is another one. Insurance is another one. So I recommend that you put these side by side, the T12, the T3, and then also what is the cost per unit per year. Comes in handy a lot. So at this point, you've got all the documents you need. You got you got your actual in-place rents. You know what the market rents are or what the potential lost lease is. That's the other term, lost lease. Your expenses, and then you can calculate your income and expense trends. So now it's time to build out your model, right? So now let's look at tomorrow. So we covered today, and we're going to go into tomorrow. How is this property going to perform? So we're going to focus on 4 of the main components, which is your acquisition costs, your financing, how are you securing your debt, or how are you raising your equity, the renovation, are you renovating this property, is it a value add property, and how are you stabilizing it? Is there a lot of vacancy, those kind of things? What's your business plan? And then your growth assumptions. Is rent growing at 3%, 5%, 10%? That's a little out there, but trying to figure out what your growth projections are going to be. So acquisition costs, what's the breakdown for acquisition? You've got your acquisition fee. You need to get paid as a apartment syndicator. You do a lot of work. This takes a lot of work to look at a deal, to underwrite deals. We've looked at hundreds of deals in the last year, and we finally got one under contract. So, you have to put in an acquisition fee because it's going to take you a lot of time to put this together, right? Land transfer tax, you got to check on your county. Closing costs, you got lawyer fees, title fees, lender lawyer fees. It adds up, right? So your overall closing costs, if you don't know what those are, set aside 2 to 3% of the purchase price as a kind of a rule of thumb. And then of course you want cash reserves. Like I said, this is your best guess, your best estimate. Sometimes things go wrong, so you want to have some extra cash on hand. Financing. Financing's been a wild ride over the last year and a half. Hopefully we see the light at the end of the tunnel and there's no more turns or jumps and bumps. But are you assuming the loan? If so, there might be a fee associated with that you got to consider. What's the term of the loan? What's your interest rate? Is it amortized? Are you paying interest only, principal and interest? How are you breaking this down? There's lots of different options, especially for the type of property that you're looking at. Is it heavy value add? Is it stabilized? Is it a development project? They all have different financing requirements, right? CMHC can go up to 95% loan to value, 40-year amortization. That's amazing. Do you really want to go up to 95% LTV? I don't know. And then in the States, so we're a US-focused multifamily firm, right? And so we got to deal with the agencies down there, which is Fannie and Freddie. And you could go up to 80% loan to value, 30-year AM. Of course, there's some other caveats to that as well. Let's look at the renovation and stabilization. So what does it cost to renovate a unit? What's it cost to renovate the exterior? Put those into your underwriting. And then how long does it take to complete some of these renovations? So, one way that I look at it is I look at the rent roll and I see how many leases are expiring each month. And if I have, 10 leases that expire each month on average, well, and assume 50% of these people stay, 50% of them go, well, that gives you 5 units that you could renovate each month, right? So that's a quick way of looking at it. So be conservative with your timeline because things always come up, right? Always be conservative, and you could pull a few levers at the end of the day if you really needed to, but start off being conservative. Get real quotes, get real numbers. Don't make this stuff up. Garbage in, garbage out. Whoop, wrong button. Sorry if I just pointed that in somebody's eye. Income. So let's look at it in 3 different ways. So you got in-place rents, and like I said, market rate, which is your loss to lease and your pro forma, right? So in-place rents, that's pretty easy. Market rate, or market rent. Again, this is usually what the current property manager puts on their rent roll as to what they feel these units can rent for. Okay. So in-place rents, the actual lease agreements for the floor plans based on the current rent roll. Your market rent, loss to lease. So let's break that down a little bit more. Loss to lease refers to the income lost by renting it lower than the market rate. So example, if you have a market rent of $1,500, right? And you're renting this unit out for $1,200, so the loss is $300 per unit per month. And then you've got your pro forma rent. So the pro forma rent is what you feel, or the property manager, you're working as a team, what you feel that you can rent these units out for after they've been renovated. Again, this is the table. Now I'm showing the other column here for our pro forma. So we're in place is at $1,376. After our renovations, we're taking it to $1,551. And if you look here at the unit breakdown, you remember how I had a Simply Modern? We have 74 units that are Simply Modern renovated and only 2 that are unrenovated. If you look at the pro forma, they match. You want them to match, right? So there's no sense in breaking them down even further. So growth assumptions. August and I, we chat about this a lot. This is how we debate back and forth about what's going on with inflation, what's going on with the city, this submarket, where are rents going? What do we feel? And it's not just arbitrary. There's a lot of discussions that go on behind it, a lot of research that goes on. So, you can do an annual rent increase traditionally, 2 to 3%. But 2021 proved to be a wild year in the state of Florida. Rents went up to 21% increase, and then they flattened right back down. So There's also other increases. Property taxes increase, insurance increases. You got to look at all these different expenses, and they may increase at different rates. So this is, again, right from our underwriting model, and we break it out each year. And I also have shown up here what the T12 and the T3 performance has been for the loss to lease, vacancy, concessions, et cetera, and what our projections are going forward for each and every year. So at this point, you got everything you need to, how the property is performing, and you hit your business plan. Now it's time to sell it, right? So which is called Terminus. So at this first bullet point here, this is a big debate. What is the exit cap? What's the current cap? What's the current cap rate, capitalization rate of this market? What are we selling it at? What's the reversion rate at in 5 years? Anybody's best guess, really. But you got to have your best educated guess. You got to factor in either broker commissions, your closing costs, other financing fees from your lender, defeasance, yield maintenance, and then if you have a disposition fee, add that in. And you're done. That's it. That's a 30,000 foot view of underwriting. I know that it's impossible for me to actually go into more details on this, but what I do want to share with you guys, and I'm going to share actually something at the end of this presentation, but I have a way for you to actually get one of our models. So once you have it done, you want to look at what's your break-even occupancy, start breaking it down even further. Are the numbers realistic? What are the investor returns? So now that it's nice and organized, it's time to break it. Let's figure this out. Let's stress test this thing, right? So some of the Excel models that are out there, they do have stress tests. And what does that look like? What is a stress test? So like lowering your NOI, increasing your cap rate. Is there no rent growth? This is a table right out of our underwriting model where we stress test it to different ways. These are just a couple examples, but we look at, if we're not holding this for 5 years, what happens if we're holding it for longer or shorter? And what happens if the exit cap, changes according to our projections? What's the NOI look like if it increases, 25 basis points or lowers 25 basis points? And making sure that you got enough coverage for your debt in case your NOI drops. So just, you want to break it. You want to make sure that you test it. Does it still work? Are your assumptions right? Where are your weaknesses? How are you, and those weaknesses is where you want to put your focus. All right, I got to speed it up here. I'm kind of running out of time here, August. But underwriting basics, metrics that matter. I'm going to cruise through this one real quick. What makes a good deal? So this is a table of returns to an investor on a hypothetical $100,000 investment. Okay, breaks it down to what are the cash flows? What's the equity multiple? What's the IRR? So cash on cash return, it just measures the overall cash flow produced by the property relative to the initial capital invested. Okay, it's cash flow divided by cash invested. So let's look at an example here. $100,000 and it earns $7,000 in year one, 7%. So we show this actually on our table. So annual cash distribution starting off at $4,700, climbing all the way up to $9,700 with the cash on cash return shown right there. Okay, for the average cash on cash. So you take the average of all the years divided by 5, and that's your average cash on cash. The advantage of cash on cash is it's pretty straightforward and easy to understand. As we like to say, you can't eat IRR. You can eat cash flow. Cash flow is great. It's pretty predictable. And then the internal rate of return. Okay, the internal rate of return is a time value of money. How is an investment doing over a length of time? It's important to know what the IRR is. It's great if you're in development projects because there is no cash flow on most development projects. So you got to know what's your value of money over time. So look at 2 examples here. We got a $100,000 investment. and you're returning 8% or $8,000 per year with the profit returned in year 5 on deal A, or deal B, 50% in year 2, 50% in year 5. Deal B has a better IRR because you get more money back up front instead of at the end, right? Another example, deal A, you get no cash flow, where deal B, you get $8,000 a year plus 50%, year 2, 50% in year 5. Gets a little better, deal A. But it looks at it 2 ways, right? So both return and time value of money. So here, this is our time value of money. 100,000 goes out. Cash flow over the time plus the sale, the profits from sale is a 17% IRR. How do you calculate IRR? If you've taken calculus or differential equations, I could solve this, but it will take me a while. There's a simpler way to do it in Excel, much easier way. But don't worry, you'll get a copy of our Excel here, so stay tuned. So equity multiple is basically, it reflects how much is your capital growing. So total distributions divided by total amount of capital invested. So for this deal, for example, $205,000 is your total return, which is an equity multiple of 2, just means that your money is doubled in 5 years. So equity multiple of 2 means that it's doubled. An equity multiple of 1.5 means that you got an extra 50% on your capital. So these are all different metrics that you want to pay attention to for your investors. There's other ones, average annualized return, debt yield. The list goes on, different ways that you could look at these. So we have 3 different underwriting models that we use at CPI. So we have a back of the napkin. We pretty much did that at the beginning of this presentation, if you all remember. Back of the envelope and a full underwriting model. So the back of the napkin takes you less than 10 minutes to do it. Information you need, just the broker memorandum, some basic assumptions. And the purpose of it is, does this match our criteria? And do we want to spend some more time on it? The next one is the back of the envelope. This takes about 30 minutes to do. This is the model that I'm going to be sharing with you guys. Okay, so information, it's same as a napkin, but now you can enter in your rent roll, your T12, make some assumptions, including your debt. And so the purpose of this one is to see if our initial price, are we within the guidance of the broker? Are we within 20%, 10%? Are we 50%? Is this really a deal that we want to spend more time on to go into the full underwriting model? This takes several hours to several days, collecting a lot of information, touring the property, and entering all into your analysis. The purpose of this one is so that you can submit a letter of intent to purchase. So before we submit an LOI, you got to review this with your property manager or somebody on your team or a trusted advisor, because they're going to find faults. They're going to question you on a lot of this stuff, and you got to have answers for it. If you don't have answers for it, you got to go find it. So, and then also, it's something that's worked well with me in building relationships with brokers is share your underwriting with the brokers. Go through it with them. Let them know that it's realistic. See if it's realistic. All right. Congratulations. You now know 2 of them. So I'm going to hand it over to August here, and he's going to finish off the presentation.
All right. Put your hands up for Paul. Thank you, Paul. All right, great. Now that we know how to underwrite, let's go out there and get some deals done. No, too soon, too early. Just kidding. I've spent almost 20 years in real estate. The last 5 years building a real estate private equity firm, doing close to 1,000 doors, and I'm just figuring out what cap rates are. All right, you got the going in cap rate, you got the exit cap rate, you got the property cap rate, you got the neighborhood cap rate, you got expanding cap rate, compressing cap rates. It gets complicated. Capitalization rate, as Paul was mentioning it. So if the cap rates go up in your neighborhood, that's a bad thing. The cap rates go down, compress, that's a good thing. But at the property level, you want your cap rates to go up. So it's convoluted. It's difficult to understand. So I mean, you can also look at cap rate in different ways. I can talk about this all day long. Does anybody know what a textbook definition of a cap rate is, except Paul and Rahul and Neva? Does anybody know what it is?
The return if you bought the property for cash?
Yeah, I mean textbook, right? It's the unlevered yield on cost. That's what the textbook is. But yeah, exactly. So if you bought the property cash, what is your cash on cash return on that property? So it's complicated stuff, right? The way you want to look at it is when you look at underwriting or when you want to get into the space, you want to look at it as who's going to help you to get a deal done. In this room right here where you guys are sitting, the most important person in your life is sitting in this room right now. Now, don't tell your wives and your husbands about that. They're going to be pretty upset hearing that, but that person is here. This is exactly a similar setting where we met Paul, where I met my other partners. So spend your time rather than trying to become an analyst and trying to, you got to understand the basics. Like I said, I'm the chief investment officer. I still learn new things from Paul every day. But you got to find a Paul in your life. You got to find a August in your business. You got to find a Eva in your business. You got to find a Rahul in your business, right? Rahul is an investment banker. So that's the key here. In this room, in this conference, go out there and try to meet that person and try to, build something great. All right? Thank you, everyone.
So thanks, August. That was great. This is a QR code. Hopefully it works from way back there. But this is how you can download our back of the envelope. Now, I will say, it's not ready yet. But download this. You'll get some information. And then I will send you our back of the envelope analyzer, complete with a video. So I can walk through this step by step with you guys so that you see how to enter in this information, some things to look out for, that kind of thing. So, and then if you also want to, like we have recorded a deep dive into our master full underwriting model as well. If you want that, just let me know. You won't get that through the QR code, but just come see me afterwards. So, and that's it. We'll leave it open for a Q&A. We've got some time. Anybody? Yeah.
So one of the things that you mentioned is in your rent roll, you didn't mention anything about move-in dates. I think it's very important to mention in Ontario we have rent control, and it's important to be able to project what type of turnover you're getting in a building.
Yes.
And when you can expect your projections to actually come true.
Yes, that's a very good point. On professional managed buildings, they do show when a unit is first occupied, so the move-in date, when the lease is expiring, the move-out date, and then they also track on future tenants that are coming in, so you get to see that. And it is important, especially when it comes down to rent control. And it gets more complicated when you're dealing with rent control. And that's a number that you have to factor into your underwriting where, fortunately for us, we look at landlord-friendly states. And so we don't have to deal with that extra lever. But if you're dealing with in Canada, yeah, those are definitely some considerations that you have to take into mind. Yeah.
Questions? No questions? One over there. Maybe we can take this one here. Sorry, we don't have a mic. You just got to.
Yeah. Go over the IRR and equity multiple.
Sure.
Okay, let me go back. So equity multiple, total distributions divided by total invested capital. So if you got $200,000 of distributions that came at you from cash flow and the sale, and you had a $100,000 investment, that's a 2x multiple. Just like I went the wrong way. Just like that. As far as IRR, whoops, am I going the right way? There we go. You want the formula? In Excel, Excel, it's equals X IRR, and then that So it's pretty easy in Excel. I don't have to enter in some complicated formula. So, yeah.
If I can't get the QR code, is there somewhere else where I can get it? For some reason it's not.
Yeah. Is it just you, or is other people having issues with the QR code? No? Okay. Just you.
You can stop by our booth and have a chat when you get a moment. Not a problem.
Yeah. Feel free to stop by, and I'll dive into it, and I'll make sure that.
We had a question down there as well, but go ahead.
Yeah.
There's one right there.
I have a question. My question is about the cap rate.
Mm-hmm.
So I understand that that's the required rate of return. But what is my required rate of return? Like, I don't want to be delusional and say that, okay, like 10% or 15%, but where do I start?
Yeah, it comes down to your own investment thesis. Yeah, sorry. Yes, he was basically asking, what is his expectations on return, for himself, right? That's the summaries. So what is good for him? What's a good return to himself? And that it all comes down to your own investor thesis. Do you want cash flow? Do you want depreciation? Do you want appreciation? Are you looking for security? All these things you got to ask yourself and figure out, what is best for you. Are you trying to survive off the cash flow, or do you have enough equity that you don't need this cash flow, and you're doing preservation for, future generations, for your children, for your children's children, that kind of thing. So I can't answer that question for you. That's something that you're going to have to spend some time with yourself.
Another way is also what constitutes it is where is your equity coming from? If you have investors, there's certain return metrics they're looking for.
True.
Right?
Yeah.
So look at it this way. When the banks lend to us, for example, they base off their spread that they make from us over the 10-year treasury. So that's their basis. Every investor is different. Some investors, for example, in our deals, if a deal is not making close to 20% average annualized returns, we're not going to look at it. Those are the numbers we look for. So it depends, where is your equity coming from? What's your thesis, like Paul was saying? That's really builds that.
Yeah, go ahead.
You mentioned that there is a situation where the compression of the community's cap rate is a good thing. Can you speak a little more on that?
So cap rate compression overall, if the cap rate comes down, it actually increases the property value. So that's the way the math works, and it doesn't make sense. So
if you're the owner of it, you want your cap rates to go down, right? If you're the buyer, you want the cap rates to go up.
It gets a bit confusing because on the property level, you want to increase your cap rate because that's your cash on cash, right? That you're making. But on the neighborhood or that market, you want the cap rates to compress. So I think we had a question over there on the other side.
Yeah.
Somebody put their hands up back there somewhere.
I was going to ask about compressing cap rates. Pretty counterintuitive, so it's good to go deeper into that.
Yeah, sure.
Started at great surface, and maybe there's another way you can explain it, or
Compressing cap rates as far as.
just like, why a high cap rate may not be a good thing requiring.
Yeah, another way of looking at cap rates is really the risk associated with the property or the deal. It doesn't have to be an actual property, it can be the deal, right? It doesn't have to be real estate. Everything can have cap rates. In buying businesses, they call it EBITDA or what have you. So, cap rate sees the risk. So if a property or if a deal has a lot of risk, the cap rates are higher. If it has less risk. So for example, properties in Toronto or Vancouver, the cap rates are really low because the appreciation is there, it's stable. There's a lot of security there. So those properties have very low cap rates. Some other properties in tertiary markets have very high cap rates. So, and then another thing that kind of affects the cap rate is also interest rates. If the interest rates are going down, cap rates also end up compressing. So they go up, cap rates go up.
This is a big debate between us all the time. So, where are we at? Where are we going to go? In fact, nobody really knows, but you have to make your best guess, and using a lot of analysis and market data and trends. Yes?
What would, say, your personal investing theory look like when you look at cap rates or their company side? What do you look for in deals that yes, it's good?
Okay, good question. He's asking, what does our investor thesis look like for our deals for CPI? So
in relation to cap rates, right? Yeah. So, we got to look at a few different cap rates. So we're looking at going in cap rate, and Paul does the analysis on the deal and figure out what's the cap rate we're buying the property at. For example, on this deal, we're buying it at 6.6 cap. But we also want to know what the market cap is, and we do that through research, what the sale price has been, what the NOI is for those properties, and we figure out the market cap. And then we also have to forecast what is going to be our exit cap, because that number really changes the numbers on all the return metrics for the investors. So usually what we do, depending on our going in cap and the current market cap, whatever is higher, depending, I mean, if the going in cap ends up being higher than the market cap, then we use the market cap as our basis. So for example, in the current deal, our market cap is 5.5, going in cap is 6.6. So our exit cap, we leave some buffer for ourselves. We do our exit cap at a 50 basis points higher than our going in cap, and that gives us some buffer in case the market softens or what have you. It does get a bit complicated, but
yeah, and you could be also buying a property that has a very high cap rate based on the in-place rents, and that's is it a property that's a heavy value add? Is it being poorly managed? The NOI is actually just really low, and you're buying it for a really high price, which would change that cap rate. So, but what we look at too in our underwriting is what's the cash on cash. Cash on cash is like the most stable way of looking at any type of metric or the returns to an investor. The exit cap can change, everything else can change in the market, which could affect your average annualized return or your IRR or your equity multiple. But the cash on cash is more, it lasts. Yeah, you can set your clock to it basically. Yeah.
So you were talking about it, the entry part being reflected on the moderate margin. Are you guys have on that on the model that you guys are using?
Yeah, in the model that so he was asking like the returns set back to the investors in our model that I'm sharing.
Yeah, in the end, just in case that the market softens, that margin.
we do. We have it. Yes, we built it. Yeah, exactly. 50 basis points above our going in cap.
Yeah.
One more question, and it's about the illiquidity. So let's assume that you're thinking that it will be hard to sell this unit or this apartment.
Okay.
Where do you incorporate this illiquidity premium? In your cap rate or in your assumption?
You mean leasing out the unit or selling the property, exiting the property? Okay. Yeah. So that's why cash on cash is great, because like if anything were to happen in the economy, say like the cap rates go out of whack, the interest rates go out of whack, which has happened in the last couple of years. First of all, you want to underwrite conservatively, right? So that a lot of these issues that can happen will happen, and so that you at least got some buffer within there. So your exit cap being a higher exit cap, your rent growth being a very low rent growth, your expense growth maybe a higher expense growth. These are a lot of levers that you could pull within your model, and that's why you do sensitivity analysis, just so you know, okay, well, if everything goes to hell in a handbag, how are we protected? How are we protecting ourselves? How are we protecting our investor capital? Another thing too is like leverage. On this deal that we're currently under contract on, we have 55% LTV, very low. We chose that for a reason, right? We wanted to safeguard our investor capital by going at the lower leverage, which increased the cash on cash return, right? Yeah, it's a little bit more equity for us to put into the deal, but because it's such a low leverage and because of the market volatility that has happened over the last year and a half, and a lot of syndicators that are out there are 80%, 90% leveraged, they're in a lot of hot water. Some of them are being foreclosed on. We don't want that to happen. So that's why we're making choices like that to safeguard the investor capital as much as possible.
But touching on exit assumptions as far as what is your business plan, two things affect that the most. One is your debt. When is your debt maturing? That kind of tells you when you want to sell the property, right? Because if your debt is maturing in 5 years, but you want to sell it in 3 years, you're going to pay a penalty, right? If your debt matures in 5 years and it's a bad market, you got to refinance it. Interest rates are high. So that's something you got to guess on. Also, what your business plan? Are you buying a value add where you're doing a capital expenditure renovation? When is that going to be done? Is that going to be done within that kind of timeline of the exit? So those are another question down here.
Who wants to purchase the property, and let's say they counting on evicting all the tenants because they want to rent the entire place. Of course, those, according to our here, have the right to get that unit within a year. Any tips on how to avoid that in a legal way?
Ooh.
Yeah.
I am not a lawyer. I'm not going to answer that question.
Everybody wants to say it's like we all want top market. We all want that.
Sure,
We're buying
sure.
property this amount.
Yeah.
How do we make sure that we're getting the highest amount of rent
Yeah.
and doing it in a legal manner
Yeah.
and not having to invite those low-paying tenants back into our lives?
Fair enough. Fair enough. That's a fine balance.
That's actually a business plan.
That you guys deal with every single day?
Well, we don't, because we only invest in states where there's no rent control laws.
Yeah, well,
So-
we're a little different here.
Exactly,
Yeah,
right?
yeah.
So, but that's an actual business plan for many multifamily investors
Yep.
in Canada, right? That's what they deal with. You know, certain provinces like Alberta, there's no rent control, but here there is. And that's an actual business plan. It's the creative ways of getting tenants out. And when Paul was talking about loss to lease, the loss to lease in these properties where a tenant has been staying there for forever is huge. It's $1,000 instead of that kind of $200 to $300 bump that we see on our properties.
Awesome. All right, that was great. Thanks, guys.
Absolutely.
Thank you.
Beautiful. Okay, so